Welcome back to Market on Close. I'm Caroline Woods. Just a few minutes left in the trading day, about 10 minutes left. It's time for the big picture. Let's welcome in the team from Charles Schwab. Kathy Jones is Chief Fixed Income Strategist at Schwab Center for Financial Research. And Michelle Gibley is Director of International Research at Charles Schwab. Kathy, Michelle, great to have you both here with us. Michelle, let's start with you because I want to talk about, we saw that the China rally here sort of fade despite the fact that stocks in China had their best day since 2008. This, of course, after new stimulus measures announced over the weekend. Break down those stimulus measures for us in terms of really targeting the housing market, right? And how effective you think those will be.
Yeah, I think, last week we saw kind of a knee-jerk reaction back to the old playbook that Chinese stimulus is going to boost construction. But, China's weakness is due to a lack of consumer demand, due in part to the property slowdown and an overhang of excess property inventory. One of the, some of the measures over the weekend were to reduce restrictions on buying inventory. That's not really going to help if you're worried that the price is going to fall. So I think that's maybe a miss from what is typical. Additionally, the issuance of sovereign bonds, they're not expected to fund infrastructure construction. So, Chinese stimulus may not boost commodity demand as it has in the past. What we really have is low confidence by consumers. Now, we could see a boost of confidence from the measures announced in terms of, lower mortgage payments and the stock market rally. And it could create an economic bounce in the short term, but we really need to see for, a longer term rally, we need more fiscal stimulus in terms of larger and in terms of details and, really to improve that business and consumer confidence.
So what we've seen from China isn't enough just yet.
Not enough yet. In fact, so far this year, they are in fiscal tightening. So we really need to see a lot more on the fiscal side to boost the economy.
Okay. All right, Kathy, here in the U.S., we heard from Fed Chair Jerome Powell today. He talked about the solid, strong overall economy. We did see markets sell off a little bit following his remarks about a little bit slow and steady pace in terms of interest rate cuts. Kevin Green did point out the volatility could be linked to things outside of the Fed as well. But just overall, what was your takeaway from Powell's comments? Did you learn anything new?
Yeah, he really didn't say anything that he hasn't said many times before. And I think what affected the market in terms of what Powell had to say was that he kind of took a 50 basis point rate cut off the table as the next move. So he basically said, don't expect that to happen. So I think there might have been some hope among some traders that he would come out uber dovish and talk about the potential for another 50 basis point cut. But he didn't do that. And they did talk about how the economy is moving along pretty solidly. Things are pretty good. And that, they're still poised to cut rates, but not rapidly.
Okay. So, Kathy, what's the takeaway for fixed income investors?
Yeah, we're still in the same place where yields are coming down. We do expect steeper yield curve as short-term rates come down faster than long-term rates. And when we look at the 10-year, it's kind of fair value here. It has been for quite some time. And I think that's why the market's just sort of churning around this 375, 380 level, because it doesn't really have any direction from here. But the overall direction of travel for rates is lower, and we do expect that will happen over the next 6 to 12 months. So we continue to like an intermediate term duration for portfolios, and you can look at investment-grade corporate bonds or municipal bonds if you're in a high tax bracket and look to lock in some of those yields for the next couple of years as rates come down.
Okay. All right. Apologies for the noise here. I'm working over a trading floor that's watching the Mets game, and clearly all Mets fans here. Michelle, let's bring it back over to Asia. We talked about China, but I also want to hit on Japan because very different day for the Japanese markets. Saw substantial weakness. It sounds like new prime minister concerns, some political concerns over there.
Yeah, I think Japan's market is really reacting to some uncertainty regarding the election. On Friday, we had the Liberal Democratic party election, new Prime Minister Ishiba. As a result, the yen rallied in reaction on Friday. That was because Ishiba's win was kind of opposite of the leading candidate going into the election, who opposed rate hikes, while Ishiba supports rate hikes. And then, today we're seeing a reversal. So we're seeing a weakening of the yen after Ishiba tried to walk back his hawkish stance over the weekend. He said he supports the independence of the Bank of Japan, and he called for a general election to happen on October 27th. So we kind of have this interim period here where we don't really know what the new policies are going to be, or if they're going to be more of the same old policies.
All right, certainly weighing on the Nikkei today. We'll see what tomorrow looks like. And Kathy, just want to hit on the jobs data later this week, because that's, of course, going to be under scrutiny by this market. What are your expectations for this week's jobs print, especially Friday?
Yeah, so for Friday's non-farm payroll, we expect it to be a little bit below the consensus. I think the consensus is around 145 or so for non-farm payroll. I think it could be a little bit light on that, partly due to the fact that we've seen downward revisions, which tends to mean that going forward, things will be softer. Also, depending on what the JOLTS figures tell us earlier this week, it looks like, getting a new job is getting more and more difficult. There's less hiring. So that would tend to bias us to the low end in terms of hiring. Still a solid number, 110, 115. Still a very solid number for non-farm payrolls, but not as robust as the trend was over the past 12 to 18 months.
Okay, Kathy Jones, Chief Fixed Income Strategist, Schwab Center for Financial Research, and Michelle Gibley, Director of International Research at Charles Schwab.